All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Monday, everybody. A new week is upon us. Today is March 17th, 2025. And the top story this morning, we got some economic data just a few moments ago. Retail sales for the month of February, they were a little disappointing. They weren't awful. They weren't terrible, but they came in below expectations. The actual number, 3.1% year over year. That's pretty much in line with the core rate of inflation. So no big blowing away of the minds there. I mean, it's down from 3.9% last month. So you can see a little bit of a decline in the consumer there. Nothing new. Consumers have been hurting for quite a while. The month over month number, 0.2%. That's pretty disappointing. The market was expecting 0.6%. So, further signs of stress among consumers. The top 10% doing really well is no longer enough to maintain growth in consumer spending. Sooner or later, what happens on Main Street catches up with the whole economy. So, look, there's nothing in there that's really going to change the Fed's mind about what's coming up later this week. I don't think it's going to move interest rates. Markets kind of shrugged it off. There was a little bit of a green candle when it first came out. Maybe a little bit of bad news is good news mentality there. But really, it's not that big of a needle mover. Now, we did get the New York Fed's manufacturing index at the same time those retail numbers came out. And that number was dreadful. Negative 20 versus, I think, negative 0.75% was the one that was expected. Big decline in the New York Fed manufacturing activity. Now, guys, this is February data that we're showing here. So, I know there's this whole Trump goggles, all roads lead to tariffs going on today. Tariffs didn't hit until March. And even in March, most of the tariffs were delayed until April. Some tariffs went into effect in March. It's not tariffs that are driving this New York Fed number so terribly. It's not tariffs that are driving retail sales number lower. I mean, I think you can't see any article. I mean, look at Bloomberg. You'll have paragraph, and then this story comes amid Donald Trump's unrelenting trade war about tariffs. Everything is about tariffs, no matter what you ask. It's got nothing to do with the data in February. The data just kind of sucked on its own because before we even started talking about tariffs, I mean, the legacy press is finally admitting it, that the economy kind of sucked on its own before that happened anyway. But that was a pretty big decline, the worst number in over a year for the New York Fed, slowing manufacturing activity. If you actually open up the report in Trading Economics and you look at the factors that make it up, it was bad across the board. There really wasn't any good news in there. Also of note this morning, I'm starting to see a lot of articles in the financial press about the iPhone 17. And I don't know if this is by design or not, or if it's Apple just trying to be okay, everybody, let's all forget about the iPhone 16 and let's move right on to the iPhone 17 that's coming in a year. Don't worry, it's going to be great. You're going to love it. And I'm just sitting here no. Oh, no. I was promised an AI phone from Apple. WTF, Apple. You guys were viewed by Main Street or by Wall Street as behind the 8 ball on AI. And oh my God, all the other Mag 7 were doing these amazing things with AI, even though not one of them has made a freaking penny of profit off of AI yet. None of them. Only NVIDIA has made money selling the hardware. Everybody else is burning through cash. And Apple's well, everybody else has an AI project. I guess we better get one. And the engineering team is hey, Tim Cook, it's not ready. It doesn't work. And Tim Cook says, I don't care. The stock is down. Release the commercial. Promote our AI phone. Engineers, you've got a month to figure it out. And that month came and went. The engineers couldn't figure it out. iPhone 16 has been around since October, September of last year. And we're finding out recently that Apple Intelligence, the new upgraded Siri, is not going to work until 2026. Apple may have burned some very loyal bridges with what they did with the iPhone 16. CNBC promised me an upgrade super cycle, and they said, don't worry, it was going to propel the stock to new highs, and demand was insane, even though all the analyst notes and the channel checks were suggesting that iPhone shipments were down. They continued with that ridiculous hype. Just because somebody stamped AI on the box, everybody thought it was going to sell. And hey, if that's indicative of this whole bubble, and I don't know, hey, I just throw it out there. You guys do what you want with it. But Apple's yet to really answer for that, although the stock is down double-digit percentages year to date. And another story going on this morning. This one, my moderator Mish found this one, and I was blown away by this story. It really snuck up on me. Greece has just had their credit rating, wait for it, raised by Moody's. Greece had their credit rating upgraded. And I remember seeing that saying, oh, this has to be a typo. Greece is like the poster child for government debt and deficits running out of control and excess spending. Nope. Greece apparently has righted the ship, and they've done one heck of a job doing it. The national debt in Greece is falling relative to GDP by 40% in just the last couple of years. GDP is growing. Their economy is growing. The government is running a budget surplus. I mean, who had on their 2020s bingo card the Greek government running a budget surplus amid a growing economy and shrinking debt to GDP? Now, look, Greece, it was not pain-free. Greece has had a rough go of it for the last 10 years. Do you guys remember all the riots in 2015 over all the austerity and everything that was going on in that country? The point is, you can come out the other side of it. And when I saw this story, I was really shocked to see that. And, hey, look, there's something going on right now. There's debatable about to what extent, but we've seen a lot of things from Secretary Bessent and a lot of things from the current administration saying they're more focused on the real economy, this endless number go up, this phony financialization. It's got to stop at some point. And they're more worried about the real economy. Meaning like, hey, we don't care about the stock market. We're more worried about what's going on Main Street. Now, I don't know if that's going to look like austerity. Doge has been cutting a lot of jobs. They've been laying off federal workers. It's already showing up in the airline numbers. Airline profit warnings are coming out because government employees aren't flying as much. Point is, you can come out the other side of that. Now, it's painful. It sucks along the way, and I don't think Americans have any stomach for what's coming. I really don't. I think these poll numbers are going to swing real fast once the real pain arrives, and it has only just started. But the point is, you can come out the other side of it. Greece has just proved it, and they had their credit rating upgraded. And last but not least, we're bombing the Houthis again. Somewhere in a workshop, there's a little chalkboard that says days without war, and the guy is erasing the number and he's putting a 0 on there because, okay, we're fighting again. There was talks of ceasefires over here, ceasefires in the Middle East, ceasefires in Europe. Nope, we're having another war. We started bombing the Houthis over the weekend. The Houthis have been threatening shipping again. They said that the Red Sea was off limits to Israeli and U.S. ships. And keep in mind, guys, if somebody sneezes and it sounds like the word Israel on board a ship, they just say, it must be an Israeli ship, launch a missile at it, launch a drone at it. So that's going on again. Yep, more war. Yay. Things go boom. Why don't we shrink my big melon of a head and let's see what's going on in the markets today, shall we? And guys, don't forget that like button and that subscribe button for the YouTube algorithm because we do this one every day. And once again, the fear greed index at CNN is in extreme fear territory. We've been here for quite a while. We don't normally spend this much time down here. Normally, tipping into extreme fear is like your buy signal that, hey, the dip buyers should arrive any day now. Dip buyers, are you out there? Anybody? Somebody in the back? No? Okay, no dip buyers yet. But we remain in extreme greed or extreme fear territory on this index. Now, I just want to show you guys the fear greed index is made up of several components. The momentum component, extreme fear, stock price strength, extreme fear, breadth, extreme fear, put the call ratio, extreme fear, volatility is neutral, safe haven demand, extreme fear. And then look at this, junk bond demand is actually in greed territory. Now that's kind of interesting. Junk bond demand, the one category that's in greed territory, it was actually in extreme greed territory just a few days ago. This measures the spread between yields on safe haven assets like government treasuries and then the amount of yield on junk bond debt, on risky corporate bonds. And if that spread falls, that means people are bidding up the price of junk debt, which means there's not a lot of price discovery going on in the bond market. And, you'd think people amid the worries of tariffs and the worries about a shift in the economy, you'd think you'd be seeing spreads blow out in junk bond debt, but we're not. And gee, I wonder if this has anything to do with all of this garbage debt, all of this private credit crap being parked on the balance sheets of pension funds and people's retirements. I wonder if that's why we're not seeing junk bond credit spreads blow out right now. This does not smell right. Something tells me people's retirements are being used as exit liquidity for these crooks. Keep an eye on junk bond spreads. It's just a theory of mine. Right now, the S&P 500, though, it's in positive territory. We were bearish most of the morning. You can see here we got a little bit of a green candle off of that retail sales data. The market liked that a little bit. So just 1 point in positive territory. All right. The Dow, meanwhile, still negative, down by about 55 points or 0.13%, although it has clawed back some of those losses after the release of that retail sales data. And the NASDAQ is up 30 points or 0.16% higher this morning. So stocks are eking out a little bit of a gain here. Where do we go once the opening bell rings? We'll see. We did catch a bounce on Friday. It was a brutal week last week, right up until Friday morning. So we'll see. Maybe some of that buying continues, or maybe we just stall out here. The U.S. dollar, meanwhile, is a little bit weaker this morning, 103.54. That's down by 17 basis points or 0.16%. I was looking at the euro and the yen this morning. Neither of them is really surging here. So it's a modestly lower dollar, but no big fireworks in the Forex market this morning. Looking over at the yield curve, again, not a lot of movement here. The 30-year Treasury is down by 1.7 points. The 10-year Treasury is down by a fraction of 1 point at 4.309. The 2 years at 4.050. That's up by 3.5 points. And the 1 month is essentially unchanged, up maybe 1 point, 4.311%. Not a lot of movement in yields this morning. Now, looking over at commodities, we've got gold is modestly higher here, $2,988. That's up by about $4.50 for spot gold, 0.15% higher. We very briefly were above that 3,000 mark for a little bit this morning. I just want to show you guys this. These are daily candles for the gold chart. You can see 3,000 for the last couple of days here. It's acted, let me get rid of this thing. It's acted a little bit like a ceiling. I got that dotted line at 3,000. I wouldn't be surprised to see the gold chart stall out here for a little while. I'd love to see it blow right through it. 3,000 is a big psychological barrier. I think we got a lot of program selling that's going to happen at that level. So don't be surprised to see gold get a little boring here for a little while. Gold is supposed to be boring. I'm just throwing that out there. Meanwhile, spot silver is down a little bit here, 23 cents or 0.7% lower, $33.54 for spot silver. I still like the shiny. Copper is up by about 0.25%. Platinum is unchanged, as well as palladium, both down a couple of pennies here, essentially flat for the day. And WTI crude oil is at $67.54 for May WTI futures. That's up by about 64 cents. Or about 1% higher, still in the high to mid 60s for crude oil, despite warnings that the Saudis will increase production at any moment. And looking at Bitcoin, once again, we're still here in the low 80s. $83,160 is priced on Coinbase. It's technically up a few $100 this morning. But guys, I've been talking about this for a couple of days. This 200-day moving average, it's acting as resistance here. This really does not look good for Bitcoin. Bitcoin needs a catalyst higher to break above this 200-day moving average, or it is at risk of a big-time technical breakdown here. This is now almost a week. It's been hitting its head on this 200-day line. Not a good sign for Bitcoin here. And we got this one in Bloomberg this morning. U.S. Bitcoin ETFs shed $5.5 billion in the longest run of outflows. Now, I would add Bitcoin ETFs doesn't have much history. They've only been around for about a year, but this is the longest losing streak for those ETFs in that year. U.S. Bitcoin ETFs recorded their longest run of weekly net outflows since listing in January of last year as U.S. President Trump's tariffs drove a wider retreat from riskier assets. There you go. There's those Trump goggles. I told you, everything is tariff related. Guys, this is a deleveraging. This is an unwinding of built up leverage in the system. My personal opinion, this has nothing to do with tariffs, what's going on in Bitcoin. I think people just borrowed too much money. Michael Saylor. Investors pulled over $5.5 billion in total from the group of 12 ETFs over the past 5 weeks, data compiled by Bloomberg show. The record outflows started shortly after Trump returned to the White House, underscoring how crypto investors, there's your Trump goggles again. $5.5 billion has left the Bitcoin ETFs. And you guys can see here, going all the way back to the beginning of this thing, we've had a couple of weeks of outflows here, but never any big negative months like we got in February. So This is a first. Let's also talk a little bit about this story going on this morning. Klarna dethrones a firm to offer buy now, pay later at Walmart. Now, this is kind of interesting because Klarna, outside of CoreWeave, Klarna is arguably the biggest IPO of the year. I mean, CoreWeave is going to be bigger, assuming they actually do IPO. There was some rumors that the CoreWeave IPO may be in jeopardy going around late last week. Wouldn't that be hilarious? But right now, Klarna actually getting a W here this morning. Klarna is partnering with Walmart backed OnePay to offer buy now, pay later to U.S. shoppers, replacing Affirm as the retail giant's fast credit option. Klarna will be available via finance app OnePay at online and physical checkouts of Walmart, according to a statement on Monday. Affirm Holdings is currently a Walmart partner, but Klarna will become the exclusive option for installment loans once the integration is rolled out this year. So Klarna just moved in and shoved Affirm right out of the way here. Now, this is important, guys, because the IPO market has been stalled or frozen like the housing market for the better part of a year and a half now. And investors are watching this CoreWeave and this Klarna IPO very closely for a sign that maybe deal making is going to pick up again. So, I mean, the market really needs these IPOs to go well. The Klarna IPO, in my opinion, not nearly as important as the CoreWeave IPO. I think if the CoreWeave IPO is a dud, or if they have to pull it at the last minute because they're worried it's going to be a dud, that's it. That's the pin that bops this bubble. The Klarna one, though, that is important as well. Right now, Affirm stock is down 7.3% on this news of them losing the Walmart deal. Now, it was down as much as 14% earlier this morning, so Affirm is clawing back some of those losses here. But that's one to keep an eye on as well. Let's talk about the retail sales data here, guys. Again, not too much to read into this. Year over year, it was up 3.1%. That's basically right in line with core inflation. Now, it has come down for a couple of months. We had some euphoria post-election. You saw big jumps in November and December, and now we're heading back down. Now, on a month-over-month basis, retail sales increased just 0.2%. The market was expecting a 0.6% rise. So this is disappointing here. Sales at non-store retailers recorded the biggest increase, up 2.4%, followed by health and personal care stores, food and beverage, general merchandise, and building materials. All those categories were up. In contrast, declines were seen at food service and drinking places, down 1.5%, gas stations down 1%, clothing down 0.6%, motor vehicle parts and dealers down 0.4%. You guys notice a lot of auto stuff here. Vehicles, parts and dealers, gas stations, all negative. Keep in mind, guys, things are tough in the auto industry. I got my buddy Tommy coming on the channel later this week. We're going to talk about the auto industry. Sporting goods, hobbies, musical instruments, bookstores were down. Miscellaneous store retailers are down. Electronics and appliance stores were down, and furniture stores were flat. So not a good week, or not a good month in February. And again, guys, all this data precedes the tariffs. So this is not a tariff story here. It's just not a very good retail story. Now, we also got some lousy data from the Empire State Manufacturing Index today. This was really bad here. The New York Empire State Manufacturing Index fell 26 points to negative 20 in March of 2025. That is the lowest since May of 2023 and below market expectations for negative 0.75. Now, I don't know how they're giving us March data here. We're still in March. So I guess this is like mid-February to mid-March. I don't know. But look at some of these descriptions here. Both new orders and shipments fell, with the new orders index dropping to negative 14.9 and shipments to negative 8.5. Despite this, inventories continued to grow. Inventories growing, that could be a sign of forward buying, moving up some of their supplier purchases in order to get out in front of tariffs. We saw that big blowout in the trade deficit possible. That's contributing to some inventories here. Let's see, what else do we have? Inventories continue to grow. Employment and hours worked showed slight declines. Input prices rose at the fastest pace in more than 2 years. That's interesting because we've seen some declines in the inflation prints here, but they're saying input prices rising the fastest pace in 2 years. Selling prices also increased. Business optimism continued to decline for the second consecutive month, with future business activity index falling further to 12.7. Capital spending remained weak, and firms expect input price increases to persist while supply availability is expected to decrease slightly. Guys, if you're looking for the silver lining or if you're looking for the good news in this New York Empire State Index, sorry, there ain't one. This was nothing but bad news here. This was really terrible. And again, you got to go back a couple of years to find data worse than this. Not since looks like the beginning of 2024 have we seen a number this low. Now let's talk a little bit about Apple, guys. This is kind of important here. Apple's iPhone 17 Air is a step toward a slimmer, port-free era. And I'll be honest with you, I don't care at all about this article. All right, I read the article. There's nothing great in here. They're just like, oh, don't worry, that next Apple iPhone, it's going to be so great. The point is, why are we still talking, or why are we already talking about the iPhone 17? The 16 is not that old. And that's the point. Apple wants you to forget about the 16. And we got this one in Market Watch. Now, this is from yesterday, but this is important. Apple now faces a problem far bigger than tariffs or weak iPhone sales. A prominent Apple blogger says the company squandered its credibility by advertising Siri features and an iPhone 16 selling point when they were nowhere near ready to use. They started marketing a product that they hadn't even built, and they failed to deliver on it. And this is from Apple. Apple is known for minimalism, for protection, for attention to detail, for getting things right, for not overhyping things. And unfortunately, they jumped on this AI bubble, and they may have really damaged their credibility. Now, Gruber, who writes the respected Darling Fireball blog, didn't mince words in arguing that Apple has damaged its credibility by teasing new artificial intelligence capabilities that were far from ready for prime time. Damaged is arguably too passive, Gruber wrote in his Wednesday post. It was squanderia. There's a new one there for you, squanderia. This didn't happen to Apple. Decision makers within the company did it. Apple first began talking up its AI features at the WWDC developer event last June, promising a more contextual version of the Siri voice assistant. For instance, a friend could text you their address, and you could ask Siri to add that address to the friend's contact, and Siri would know what you meant. The company talked up the Siri enhancements further when rolling out the new iPhone lineup in September. And I remember Apple stock surged. The whole market surged on this news when Apple talked up these features. Then Apple touted the features through its advertising, including with a commercial showing a woman who asked Siri for the name of someone she met months back at a certain cafe, who decided these features should go in the WWDC keynote, with a promise that they'd arrive in the coming year, when at the time they were in such an unfinished state that they could not be demoed to the media, even in a controlled environment, Gruber asked in his post. And this is Silicon Valley that has a reputation for faking demos. They couldn't even fake the demo. It just didn't work. 3 months later, who decided Apple should double down and advertise these features in a TV commercial and promote them as a selling point for the iPhone 16 lineup? Not just any products, but the very crown jewels of the company and the envy of the entire industry, when those features still remained in such an unfinished or perhaps even downright non-functional state that they still could not be demoed to the press. Gruber noted that Apple teased yet to launch Siri features in various iPhone 16 commercials that may now not be ready until months after the iPhone 17 lineup is unveiled. In other words, this was just straight up false advertising. I mean, they're showing commercials with this girl walking down the street, and she said, "Hey Siri, do this thing that you can't do." And Siri's like, "Sure, I'll do that." Oh my God, my phone just lit up when I said that. I'm sorry, all my iPhone users out there. I said, "Hey Siri," and the phones all started listening. There it goes again. Maybe I shouldn't do that. Guys, the point is, Apple was so behind the eight ball that they just jumped on this AI bubble, and they regretted it. And look, this whole AI bubble has been promises about how, oh, the world is going to change and we're all going to be put out of work and go on universal basic income, but AI is going to do these wonderful things. What has it done for us? After all of these years, after $16 to $18 trillion in market cap being just willed into existence in the S&P 500, and all these imbecilic stock bros and the idiotic things that they're posting on Twitter, like AI will invent new physics. What the heck does that even mean? And what do we have to show for it? Nothing. We have an Apple iPhone 16 built for artificial intelligence that doesn't yet work. 6-8 months after it was unveiled. Apple stock is unchanged this morning, $213.22, down 0.25%, but it is down almost 15% year to date. It should be down more than that, to be honest with you, after what they did. Now, let's talk real quick about Greece here. Let's end on a positive note, shall we? Well, I guess this isn't going to be the end of it, so much for ending on a positive note. But Moody's upgrades Greece to investment grade on strong fiscal recovery and stability. This really took me by surprise. This article, I had no idea things in Greece were actually going well. Global ratings agency Moody's upgraded Greece's rating to Baa3 from Ba1 on Friday, citing quicker than expected improvement in public finances and the country's greater resilience to potential future shocks. Based on the government's policy stance, institutional improvements that are bearing fruit, and a stable political environment, we expect Greece to continue to run substantial primary surpluses, which will steadily decrease its high debt burden, Moody's said in a statement. And I was blown away by that. I had to double check it. I remember seeing, wait a minute, surpluses for the Greek government? That can't be right. It turns out it's true. Greece ran a budget surplus last year, 3.5% of GDP in surplus. That is more taxes that they took in than they spent, 3.5% of GDP. That's massive. The U.S. is running 6.5%, 7% of GDP deficits. Things going really well in Greece. Since 2020, the nation's debt, the highest in the Eurozone, has shrunk by more than 40 percentage points, reaching 154% of gross domestic product in 2024, and it's projected to drop further by the end of this year. Their debt to GDP ratio has shrunk by 40 points since 2020, when the rest of the world has blown theirs out. Greece is going in the opposite direction. Greek banks are steadying and returning to profit after being nationalized following the 2009 financial meltdown caused by the country's debt crisis, which put them in a vulnerable position, requiring several capital injections from the government. Last week, DBRS upgraded Greece's credit rating to BBB from BBB low, 2 notches above investment grade, citing a healthier banking sector and continued reduction in the country's general government debt ratio. Things in Greece are going really well. And man, took about 10 years, right? 2015 was when the S really hit the fan over in Greece, when all the austerity started. And I remember the sovereign debt crisis that hit back then. But there is a way out. You can come out the other side of it stronger. Now, this is not in any way meant to belittle the pain, guys. Austerity sucks. I mean, everybody's in favor of austerity until it shows up in their doorstep, right? Everybody's like, yeah, we need to cut government spending, right up until we cut government spending in the Department of helps pay your paycheck. Then everybody's like, oh my God, we need this program. This is crazy. So, I guess the point I'm trying to make is, it can be done. If Greece can do it, maybe we can do it. I mean, they're currently doing it in Argentina, and it's a mess in Argentina. There's riots in Argentina. Austerity hurts. There's a blowout in the poverty rate. But at the same time, you got government debts are coming down. Inflation is falling triple-digit percentages. It's still up. It's still over 100%, but it's falling rapidly. These problems can be fixed. You just have to be willing to go through it. We'll see if the U.S. has a stomach for this. Why don't we call it there, guys? Let's end on a positive note, shall we? I think we're going to cut it off right there. I just want to say thank you very much to Mr. Charles G., who says, good morning, all. I saw your video on Sunday, and I'm beyond mad. How dare they keep people in their homes? I can't buy a home because of that. Charles, I can tell you that is a righteous, 100% justified anger. And I saw so much of that in the comments on that video. Guys, Charles is talking about a video I just did yesterday. We recorded it Friday afternoon with Melody Wright and John Comiskey, 2 people who have done fantastic research in what's going on in FHAs. Let me ask you guys, 57 months. All right, imagine, put in your head the number, your mortgage payment, or if you're a renter, imagine your rent payment, all right? Put that number in your head, think about it. Now multiply that number times 57. Now, I'll forgive you if you can't do that math in your head. I can't either. But suffice it to say, this is a big number for most people, 57 times your rent or mortgage payment. Now, imagine if you stopped paying your mortgage or your rent for 57 months and you still were not kicked out of your house. Think about all the things you could have done, all the things you could have bought with all that money, all the living you could have done with all that money. That is what's going on with FHA loans right now. The government has put basically a de facto ban on foreclosures in effect for FHA loans. President Biden, on January 16th, 4 days before he left office, extended it by another year. This is a COVID-era program aimed to prevent the poor from losing their homes because of COVID. Guess what, guys? COVID is over. It's been over for years, and yet they still have it in place. And if you are a millennial or a Gen Z, or in particular, and man, I keep thinking about these entire generations that have been priced out of housing. There were 52,500 homes that went seriously delinquent in 2024, more than 9 months late, or I'm sorry, more than 3 months late in their payments, going 3 months without a payment. 52,500 homes, only 9 went into foreclosure. Not 9,000, 9.0 out of 52,500. The government has made it illegal to lose your house. Why would anyone pay anything? And this is the second time in 15, 16 years that I have felt like a total schmuck for paying my bills. I felt this way after the GFC when I watched all these zombie homeowners, all these people who didn't make mortgage payments for 4 or 5 years and were able to stay in their houses and had all that money. Yeah, their credit was garbage, but who cares? They had 6-figure bank accounts because they just said, to hell with it. I'm not going to pay my bill and the bank won't take my house. Eventually, the bank came for them, but here we are 10 years later, and the same stuff is going on. And some of these guys, we're talking like $1 million houses. We're not talking about middle-class suburbia, 3-bedroom ranches. These are like $1 million McMansions. These guys just aren't paying their bills, and they're not losing their house. Charles, you're right to be angry about that. I'm angry about that too. It needs to change. And if you're a millennial or a Gen Zer, you should be enraged by that. Guys, check out that video. It's at the top of my feed. Share that video. Send it to that person that you know who has been trying to save up to buy a house, and he's frustrated because he can't get anywhere, and he's ready to just give up and FOMO and say, forget it. I'll pay these ridiculously high prices for my house. Don't do that. That reckoning is coming. Just because it hasn't happened yet doesn't mean it's never going to happen. Patience will eventually be rewarded. It just can't go on like this forever. You cannot continuously reward people for being dirtbags at the expense of the people who are doing the right thing. Sooner or later, you end up with nothing but dirtbags because there's no incentive to do the right thing. I'm with you, Charles. I'm very angry about that. And yours is a righteous anger, sir. Thank you for the super chat and the support of the channel. And thank you to the Park Pasta Man. He's back. He said, market liked it equals Aladdin algos liked it. Yeah, somebody rubbed the genie or flipped over their magic 8-ball, and the algorithm says, I'm optimistic. Okay, buy the stock market. Look, I don't think that was necessarily good news, the retail data. Certainly not that New York manufacturing index. That was terrible data this morning. Maybe a little bit of bad news is good news because Fed. But I don't think this Fed is tripping over itself to ride to the rescue of Donald Trump's stock market. I really don't think so. So if you're sitting here saying Fed go burr very soon, I don't think so. I don't know. We'll see. We got the FOMC later this week. We'll see what they say. I'm sure there's going to be more, hey, would you say something bad about Donald Trump so we could run it in print? That's probably going to be the first 5 questions from the press pool because they're just a bunch of buffoons. But hey, it's just me. Thank you very much, Pasta Man, for supporting the channel. And thank you, T.A. Chapman, who says, great video with Melody Jack, putting that info with the insanity that Travis and Mitch Wexler have uncovered. They have done an excellent job over at Real Estate Mindset talking about the fraud in the property taxes. Absolutely. How do we even have an economy anymore? We have a fake economy. I mean, I'll be honest with you, T.A. Chapman. The economy's fake. And when I see Secretary Bessent in these interviews, now what the press does, they'll take the worst possible thing Bessent said, right? He'll give this long-winded statement, and somewhere in the middle he'll say, I'm not worried about the stock market. The headline will be, Scott Bessent not worried about worst market crash since ever, right? They'll always zero in on the most loaded clip and then run that as the headline. But if you listen to what they're actually saying, and so many people are just like Orange Man Bad that they're not actually listening to what he's saying. Guys, there is a reckoning coming in this economy if they actually follow through with what they're saying they're going to do. And I hope they do, because I think we'd come out the other side of it better. See also Greece. But you better believe there is a lot of pain between here and there. You got to kill this fake paper economy, this sugar high economics, or dare I say this narcotic economics. And there is no pain-free way to break that detox. It's going to be ugly. And how do we even have an economy anymore? We kind of don't. We have smoke and mirrors. And sooner or later, someone's going to pull back the curtain on that, and it's going to be a mess. So thank you very much, T.A. Chapman, for supporting the channel. And thank you very much for gifting 10 Nobody Special Finance memberships. I appreciate that very much, sir. Guys, if you got one of those memberships, be sure and say thank you to T.A. Chapman. I appreciate that, sir. And Bart Stapleton, thank you for supporting the channel. He says, Jack, what's your take on COMEX delisting of the gold kilo futures, London spot gold futures, London silver spot futures? I'll be honest with you, Bart, that's the first I've heard about those. The kilos. Now, interesting that they're saying kilo futures. It's possible, what do they do? Typically 400 ounces or 100 ounces is the typical COMEX future size. I'm seeing a little bit of a divorce from Europe in there. Just looking, I see kilo, that's a metric unit. I see London. So it looks a little bit like a divorce, a breakup of the gold market between New York and London. I don't know if we need to read too much into that or not. Bart, this is the first I've heard about this. So I'll look into this, and maybe I'll run this by Bob Coleman, because Bob over at Idaho Armored Vaults, he's forgotten more about the gold market than I can ever hope to learn. So he might be able to shed some light on this. Let me put this one in the parking lot, Bart, and then I can do a little bit more research and actually give you an informed answer on it rather than just going off half-cocked. But thank you very much for supporting the channel, and that's a good question. Thanks for bringing that to my attention. I am writing that one down in the notes. And Lisa, thank you for being a member for 13 months, who said he wanted FHA foreclosure to land at Trump's feet. Lisa, when you mentioned that, you're referring to the fact that they extended it on January 16th. You're absolutely right. That was a political maneuver to extend that FHA program, a COVID era, essentially forbearance. It's not quite forbearance, but it works the same way. A COVID era program to extend it another year is to make sure the housing bubble pops right before the midterms. That was a political maneuver. Absolutely. There was no reason to extend that program into 2026. There's no reason to extend that program into 2024 or 2023. It should have been ended years ago. Better yet, it never should have been implemented to begin with. But you know what? It's real easy to be like, oh my God, yank on my heartstrings. They want people to lose their homes. They don't care about poor people. We're not talking about poor people, guys. We're talking about crooks, freeloaders living in $1 million homes for years at a time without making a single payment at the expense of young people who have been priced out of the dream of home ownership. That's what's going on with this program. So, yeah, I agree. That was a political maneuver. Now, the question is, will Trump end it? He should. He should end it yesterday. I don't know that he's going to. He's already going to crash the stock market. Does he want to crash the housing market too? Probably not both. But politically, there is an incentive to do it sooner, because the sooner it happens, it's easier to blame it on the last guy, isn't it? Just like if we delay it a year, then, well, it's his fault, not my fault. But you're right. There's political maneuvering in there. Nobody wants to be in charge when the housing bubble go boom. That's for sure. Thank you, Lisa, for being a Melonhead for 13 months. And thank you, Aaron Hubbard, who says, older millennial at 41 with a paid-off house here. Congratulations, a paid-off house. You, sir, are the exception, not the rule. That's for sure. You are very fortunate to be in the situation that you are. I know a lot of guys who are not. A lot of people, look, I see a lot of people are just like, to hell with it. I'm going to drive a really nice car. I'm never going to own a house. This doom spending. Or I'm going to get a dog, and I can't afford to have children or own a home. So I'm going to get a dog and call that dog my son and pretend like I have a family because I got a dog. There are real world consequences of this. We're watching birth rates decline. These things are not unrelated, guys. We need lower home prices. We need substantially lower home prices. And understand, guys, I get what that means, because a significant portion of my net worth is home equity, and that goes up in smoke. And I'm telling you, it needs to happen. It's going to hurt me. I hope it happens. And no, I'm not a glutton for punishment. It's just the way it is. Although I've been a Knicks fan my whole life, I guess I am a glutton for punishment. But anyway, thank you very much, Aaron Hubbard. Congratulations on your debt-free home. I commend you for that one, sir. I'm still up to my eyeballs in debt with my house. But thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate all the super chats and all the support of the channel. Appreciate your generosity. Thank you as well to my Patreon supporters and magnanimous melonheads on YouTube. Links down below. Should you feel so inclined, check out that video I did from yesterday with Melody Wright and John Comiskey, guys. You're going to want to see that one. Hi, Mom. Hi, Dad. I love you guys. Don't forget that like button and that subscribe button on the way out. Until next time, live small and dream big.